Hey everyone, welcome back to Wealth Finance 61. Let's get into it.
Money is supposed to be simple, yet the system that governs your life is anything but simple. We trust numbers on screens, rarely questioning who writes them into existence or why. Then, without warning, a technology appeared claiming money could exist without rulers. To understand that claim, we must rewind to a crisis few truly understood while living through it. In 2008, confidence collapsed faster than markets, and institutions once considered immortal failed. Banks stopped trusting banks, credit froze, and the machinery of global finance began to stutter. The fall of Lehman Brothers became a symbol of hidden fragility. Governments responded with interventions that saved the system, but quietly reshaped its rules. Trillions were created, not mined or earned, but typed into existence by central authorities. Stability returned, yet a subtle question lingered beneath the recovery nobody celebrated. If money can be expanded without limit, what exactly anchors its value over time? That unanswered tension became the fertile ground for a radical monetary experiment. In October 2008, a paper circulated through obscure cryptography circles with little immediate fanfare. Its author, Satoshi Nakamoto, proposed electronic cash without trusted intermediaries. The idea sounded technical, almost academic, yet its implications were quietly explosive. It reframed trust itself, moving it from institutions to mathematics and distributed consensus. Bitcoin did not promise convenience first, nor speed, nor government approval. It promised something more unsettling, a system where rules could not be politically rewritten. Instead of a central ledger, thousands of independent participants would verify every transaction. Instead of authority, there would be proof, computation, and incentives aligned through design. The mechanism seemed strange, even wasteful, to observers trained in traditional economics. Computers competed to solve puzzles, expending energy to secure an invisible network. Yet this apparent inefficiency concealed a crucial economic trade-off with historical precedent. Costliness became the shield, making manipulation prohibitively expensive rather than merely illegal. Early adopters were not corporations or states, but programmers, hobbyists, and ideological experimenters. Coins held little market value, and participation looked more like curiosity than investment. But networks obey a powerful law where usefulness and adoption reinforce each other over time. Each new participant increased resilience, credibility, and the probability of survival. Price volatility followed attention, drawing speculators long before mainstream understanding matured. Dramatic booms created fortunes, while violent crashes erased confidence with equal speed. Critics declared the experiment finished after every collapse, citing instability as fatal weakness. Paradoxically, each survival through chaos strengthened the narrative of anti-fragility. Beneath the spectacle, a deeper contest unfolded over Bitcoin's purpose and future direction. Was it digital gold, censorship-resistant cash, speculative asset, or technological curiosity? Disagreements hardened into ideological fractures, exposing governance tensions within decentralized systems. Consensus, once assumed automatic, proved as political among users as within nations. Scaling debates revealed uncomfortable constraints embedded deliberately into the protocol's architecture. Protection capacity remained limited, preserving decentralization at the cost of throughput. Proposed fixes promised efficiency, but threatened to concentrate power among fewer participants. Trade-offs once theoretical became unavoidable choices with economic and philosophical consequences. Meanwhile, traditional finance observed cautiously, oscillating between dismissal, curiosity, and strategic interest. Institutions recognized both a threat to monetary control and an opportunity for new instruments. Regulatory responses varied, reflecting national priorities rather than a unified global doctrine. Certainty itself became a defining characteristic of Bitcoin's interaction with existing systems. Energy consumption emerged as a recurring flashpoint, often framed as waste versus security. Yet historical monetary systems also depended on costly extraction, infrastructure, and enforcement mechanisms. The real question was never raw consumption, but comparative function and systemic benefit. Security in any trust system demands sacrifice, whether computational, physical, or institutional. Adoption advanced unevenly, driven by crises, capital flows, technological familiarity, and generational shifts. In regions facing currency instability, Bitcoin's volatility sometimes appeared preferable to certainty of decline. Stable economies, it functioned more as speculation or long-term hedge than transactional medium. Context, not ideology, largely dictated perception and usage patterns. Shocking data accompanied the rise from negligible valuation to trillion-dollar market capitalization within years. No central issuer orchestrated expansion, no treasury-managed supply, no board-guided strategy. Scarcity remained algorithmic, having issuance predictably while demand fluctuated unpredictably. This inversion of monetary discretion challenged assumptions embedded for centuries. Every cycle repeated a familiar psychological script observed across financial history. Euphoria fueled leverage, leverage magnified risk, and corrections punished excess with brutal clarity. Observers blamed the asset, rarely acknowledging human behavior as the persistent constant. Technology changed, but crowd dynamics proved remarkably stable across eras. Failed fixes followed predictable paths, promising stability through mechanisms that reintroduced centralization pressures. Stablecoins, custodial platforms, and layered solutions expanded utility while recreating old vulnerabilities. Trust migrated back toward intermediaries, subtly reversing Bitcoin's founding philosophical departure. Efficiency gained ground, yet systemic risk quietly reassembled in new forms. Modern parallels became unavoidable, echoing earlier tensions between control, stability, and individual sovereignty. Central banks, including the Federal Reserve, explored digital currencies with different premises. Competing visions of programmable money revealed divergent priorities about surveillance, policy, and freedom. The contest was no longer technological alone, but deeply political and economic. Three takeaways emerge from this unfolding narrative of code, incentives, and belief. First, money is ultimately a coordination system sustained by collective trust rather than intrinsic substance. Second, decentralization introduces resilience and constraints simultaneously, never delivering benefits without costs. Third, volatility reflects discovery within uncertainty, not merely dysfunction or failure. The unresolved question is not whether Bitcoin wins or loses, but what its existence reveals. It exposes that monetary design is neither neutral nor fixed, but shaped by power and priorities. The future may blend models, clash violently, or evolve beyond current imagination. The only certainty is that ignoring the transformation guarantees misunderstanding its consequences. If this story altered how you perceive money, then curiosity has already done its work. Question assumptions, examine incentives, and follow the structures that quietly govern economic reality. Because the architecture of money shapes behavior long before policy debates reach public awareness, and understanding that architecture may become the most valuable literacy of the modern age.
Alright, that's wrap for today. Thanks for watching Wealth Finance 61.